Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. The Dow soars and markets rally. The market getting what it wanted from Fed Chair Jerome Powell at Jackson Hole, a sign of a rate cut coming in September. And there's just an hour to go now till the closing bell. And right now, stocks are ripping higher. The Dow up 860 points. Your broad gauge, the S&P 500, up more than 1.5%. Your tech-heavy NASDAQ up nearly 2%. The small caps, the Russell 2000, up 3.7% right now. Let's welcome in, got Lou Bassanese, Executive Vice President of Market Strategy at Prairie Operating Company and founder of thebigskinny.com. We have Fed correspondent Jennifer Schonberger and data and markets editor Jared Blickery, all here to break down the headlines. Let's get right to it, starting off with you, Jared, with the trading action so far.
As you said, this is a rip-roaring rally that we have here. Dow up 800 points. Let's chart the intraday action. And we've been talking, kind of hinting about Powell. This was when he delivered the all clear, and traders are just, and investors are just reading into that, saying, okay, September is a lock-in. I looked at the odds. They didn't go up that much, but it was enough to really make a difference in the markets today. Now, NASDAQ Composite also up about 2%. Let me just show you the 5-day. Still in the red for the week. We had a little bit of a tumble in some of the bigger issues earlier, but here's the S&P 500 over these 5 days, up 1/3% and the Russell 2000. As you said, the small caps really love the idea of more rate cuts, and they are up 3% for not only the day but also the week there. And I want to show you what's going on in the bond market, because on the long end of the curve, and I'll put this down to an intraday, we are seeing the 10-year drop 7 basis points to 4.26%. These are big moves here, and the 30-year down 4 basis points to 4.88%. Meanwhile, the US dollar losing a little bit of steam there, and we can say that is some risk on action in most of the markets we're looking at. And 10 out of the 11 sectors are in the green here. Staples just trading slightly to the downside, but these guys that you see down here, healthcare, utilities, and also Staples, were the leaders coming into today. No longer. Consumer discretionary, that's retail, that is in the forefront. That's up 3%, followed by energy, materials, industrials, and financials. So a lot of risk on that we're seeing in some diverse sectors. Tech kind of in the middle of the pack here, but NASDAQ 100 really responding positively. You see a lot of bullish action in a lot of these mega cap, Meg 7 stocks that we'd like to look at. Tesla up over 5%, almost 6%. Alphabet and Amazon up over 3%. Meta up 2%. Apple up 1.5%. List goes on. You can see a lot more green than red here. And that's a very similar situation that we're seeing in the Dow. You see Walmart, second day of losses, coming off of those disappointing earnings, down 1%, but not a lot of bearish action. Verizon down 1.5% as well, I should note. Just taking a look at some of the leaders here, and you can see everything. These are some of my proxies for risk. Everything in the green. Solar back on top, followed by home builders, regional banks. They like that widening yield curve that we saw, the widening net interest margin, and also Bitcoin, ARC components, oil, and then small caps. So just a broad selection of bullish sectors. Nice way to end the week here, guys.
And let's get to Jennifer, who's at the center of all this action. Jackson Hole, Wyoming. Jenna, a big day from out there. What impact is being felt after Powell's speech?
Big day, Josh. Fed Chair Jay Powell, in his last speech as chair here in Jackson Hole, opened the door to a potential rate cut come September.
The rate is now 100 basis points closer to neutral than it was a year ago. And the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
The key to this speech is that Powell said the balance of risks appear to be shifting. And he specifically noted the downward revisions in jobs during the July jobs report when he said that, quote, they were much larger than assessed just a month ago. He also noted the drop in demand for workers and the drop in supply for workers, which suggested downside risks to the job market. He said if those materialize, then it could materialize quickly into massive layoffs. Chair Powell also acknowledging the challenging position that the central bank is in right now, the fact that there are upside risks to inflation and downside risks to employment. And while the markets are pricing in a near certainty of a 25 basis point rate cut next month, former Philadelphia Fed President Patrick Harker told me this morning that if we see hotter inflation reports between now and the September policy meeting, the Fed could pivot. Listen.
I had in the last SEP, when I was on the committee in June, I had 2 rate cuts for this year. So I think September is definitely on the table. But if we see inflation moving in the wrong direction, and we've seen signs of that, like with the PPI, that was not a good report. And we're hearing other anecdotal stories where the Philly Fed's Manufacturing Business Outlook survey went into negative territory again. There's a lot of mixed signals right now.
Fed Chair Powell also unveiled changes to the Fed's monetary policy framework, dropping the average inflation targeting as expected, now just adopting a long-term inflation target of 2%. Josh?
And Jennifer, switching gears a bit, because this was also getting attention today for sure. President Trump, you saw that escalating his threat gen to oust Federal Reserve Governor Lisa Cook. What are you hearing there?
Yeah, this has become a distraction for the Fed on a day when the focus is really supposed to be on the Fed chair's speech and his last speech here at that. I think it's more of a distraction for them. It's not something that people are wanting to comment on. It's something that is not viewed in a particularly positive light. And Fed officials who I've spoken with are kind of questioning whether the authority is there to be even bringing this, and that there should be due process of law. Where are the laws right now on the books as it pertains to this? You know, if the president does end up firing Fed Governor Cook, it's possible that we will see some retaliation in the form of a lawsuit from the Fed, because the question becomes, does the president have just cause to fire Lisa Cook? And so this is something that we're going to have to wait and see how this plays out.
Another big story we're following closely. Lou, I want to bring you and get your take on all this. You were listening to Jay Powell today, Lou. You went into that speech, you were listening. Was it what you expected, Lou? Were you surprised? What'd you think?
Anything but. I was shocked at the change in sentiment, because I painted Powell really as hawkish and really holding the line on rates. And then you saw the all come in with the market too, because I think they didn't expect him to pivot. And here's where I came down. I didn't think one jobs report would change his mind, and I don't think it was necessarily the one jobs. I think it was the trend over the 3 months. But I thought the picture was still a little bit unclear for him based upon tariffs, right? We didn't see them, they were creeping in, inflation and reinflation, but you were seeing it come in other areas that weren't impacted by tariffs. So it gave him what I thought would be the cover to hold tight until you got definitive proof that there was more reinflation risk than labor market risk. So, all that to say is that we're seeing the market react wildly. I've been watching the Fed watch tool over the last week, and it's been a roller coaster from CPI to PPI to today, really proving that the market got what it wanted, but maybe that the labor market is weakening more than we anticipate right now. I think that's the main takeaway for me.
What about, Lou, and it's a point that Jen was bringing up in her reporting, this idea, Lou, that you do have a lot of data coming between now and the next meeting. What if you got a jobs report that was actually looking better than expected? You didn't see these big revisions that we saw last time, and maybe inflation came in a little bit warmer. How does that shake things up?
Yeah, I think, look, Powell's showing that he might change his mind, being data dependent, but the other thing that's just kind of an unknown out there is the September revision to the jobs report, right? We get the annual revision. Goldman Sachs says that it could be as wide as 550,000 to 800,000 jobs that for the death and birth adjustment that would take it out. And I think that's probably what's motivating the Fed right now to change its stance and be open to rate cuts. They may have some insight into that we've yet to see in the data, which is what I think has led them to this stance.
Jen, you want to hop in?
One thing, if I could just jump in here for a second, Josh, one thing I just want to note is that, Fed Chair Jay Powell is at the end of his tenure, and he said the number one thing he wants to do is pass off an economy that is in a strong position to his successor. And so we saw what happened last year this time. It feels a little bit like deja vu, right? We had a weak reading on the jobs market. The Fed ended up cutting in September and then a couple more times at the end of last year. And I think Powell is trying to take more of a forward-looking view here as opposed to just looking strictly at the data. There are clearly warning signals here, and the Fed chair wants to get ahead of this. He wants to make sure that we don't slip into recession or we don't see a deterioration in the job market. That is very important to him.
You're a longtime market watcher, market guru that you are, Jared. What do you just make, Jared, of the reaction we see today? I have the Dow up 850 points, Jared.
Well, we can also look at Bitcoin. I just happen to have the crypto screen up behind me on the Wi-Fi Interactive. We got Bitcoin up 3.5%, Ethereum up 12%. And I will say, I agree with Lou. I was a bit surprised here, but when you consider that we have some big potential revisions coming up in the next month, and maybe the Fed is privy to some data that we're not looking at every single day here, I think Powell wants to end on the right note. And if that is with a rate cut, then so be it. But the market definitely likes what we're seeing here.
All right, thank you, Jen. Thank you, Jared. Appreciate it. And Lou, looking at the market action today, listen, we're covering this. We have just popular averages ripping all over the place. The Dow, we're mentioning 850. S&P 500, 1.5%. The NASDAQ up to almost 2%. You got to look at the Russell 2000. It's up almost 4% in today's trade. What do you make of that?
I was just looking at that. It's like, we're going to rip past 4%, right? I mean, this is funny because I watched the Russell last week on the CPI, PPI data, right? We had 2 days in a row where the Russell was up 2% and then PPI came out and just smacked it back down. I think this is an economy and market that is ready to go much higher based upon the fundamentals. The big unknown has been interest rates. When will the Fed...
Do you look at this move, let me ask you this way, do you look at this move and say, hey, this makes sense, it's justified?
It makes sense based upon earnings, because if I look at not just this quarter's earnings, last quarter's, and then what's ahead, you've seen Mag 7 companies for 2 quarters in a row report 25% profit growth and higher as a group. And then the other 493 bested the estimates by double. So it was 3% last quarter, they reported 6%. Almost the same thing this quarter. And as we get into the back half of the year, the estimates are for that 493 companies to report double-digit profit growth going into Q4 into Q1. So ultimately, earnings drive stock prices higher. And we can talk about valuations, but if the earnings growth is accelerating, it now brings those relative valuations back in line where people can buy confidently because they know we're not buying Palantir at a sky-high valuation if they can grow into that. So
earnings, you say you look solid, but on Jay Powell's comments, I'm just wondering whether you think this move today makes sense, or do you think, listen, I mean, when you look through it, here was the money line, to reiterate. To me, tell me if I'm wrong, I think it's when he said, with policy in restricted territory, the baseline outlook and the shifting balance of risk may warrant adjusting our policy stance, and that was it. And then the market said, okay, boom, policy shift, policy pivot on the way.
May warrant was enough of a window. You're saying there might be a chance.
Was it more like we were heading into this, and wow, were we all wound up about this speech, right? Was it in part, Lou, was it because there had been some doubt creeping in and suddenly people were wondering, I don't know, maybe that cut in September isn't a lot. And so, hey, you got a surprise today, a pleasant surprise? It
was, because I think that PPI report last week really pushed everyone back to holding, right? I mean, it after CPI, this is the tell for me, it went to a 0% probability that the Fed was going to hold rates. And then PPI came out and it jumped up to 30%, right? So everyone would move to the other side of the equation expecting it, and now this was a complete unexpected shift. I do think, though, here's the problem. This isn't just about one Fed cut. It's about starting Fed cuts again.
Do you think you're one and done in September, or you think a series?
I think it's a series. That's what he's intimating, but that could be where the danger is, too, because we are seeing reinflationary pressures, and if the Fed keeps cutting down and you re-energize the economy
Did you think, let me just run, there tell me producers, or I have to go, but I have to get your take on this. Did you think, I also thought this part of the speech was very interesting, just talking about tariffs, inflation, when Powell says a reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Now he did put a caveat there. Of course, one time doesn't mean all at once. But what'd you make of that?
I think it's an oversimplification. We're seeing that these tariffs are not coming in one chunk. It's at different intervals, and we're just not going to know. There's not enough clarity. The rates keep changing, going higher than lower. So I think it's going to be a drag on the markets, on inflation, dragging it higher. But I think that could be counterbalanced by deflation from AI. So.
Interesting. All right. Meanwhile, let's turn to another big subject. That would be chips, because we have some breaking news. President Trump saying the U.S. government will take a 10% stake in Intel. The president discussed his conversation with Intel in the Oval Office earlier. Take a listen.
And I said, I think you should pay us 10% of your company. And they said, yes, that's about $10 billion. I don't get it. this comes to the United States of America. And I said, I think it would be good having the United States as your partner. He agreed, and they've agreed to do it, and I think it's a great deal for them.
The president is expected to provide more details today, and joining me now is Yahoo Finance tech editor Dan Howley. Dan, what'd you make of that?
Yeah, Josh, this is something that was kind of expected to come down at some point. We just didn't know if it was going to be this week or next. Obviously, the 10% had been predicted as well as far as the amount that the Trump administration would take. I think the interesting part of this was him saying we might do more deals like this. So it's unclear what that exactly means. Would it be more chip companies? Would it be other struggling U.S. companies? Obviously, there's the big push to reshore chip manufacturing in the U.S. That could be part of this. But, you know, some of the biggest chip manufacturers in the world, which are building chips in the U.S., are foreign companies, TSMC, Samsung. So, you know, what does that mean then for those companies? Would the U.S. try to take a stake in that, or would it just be U.S. companies on their own? So it really was an interesting announcement. We still don't, as you said, have the specifics on it. We're just waiting for those to come out.
Lou, I want to get your take on all things Intel. Uncle Sam's taking a stake. Yeah. You saw SoftBank with that $2 billion injection. You want to own Intel here?
No, I don't. Actually, I think in December's goodbye or goodbye segment, I had Intel as the goodbye, like waving goodbye, because turnarounds take time. Here's my thing. I don't generally love the government investing in companies and free enterprise, right, in capitalistic markets. More importantly, with Intel's case, I don't think any government money solves the innovation problem that they have. Intel is struggling to get to the head of the pack in terms of innovation. I think it's because they design and manufacture their own chips. For me, the case gets really interesting if Intel ever spun out the foundry, because then you have the potential to take market share away from TSMC, which controls 70% of chip manufacturing, from the likes of Nvidia. So for me, I don't love this on the principle of the government investing in companies, and I don't love it for Intel specifically, but I got trumped because Intel stock has been reacting pretty positively.
And Dan, while we have you, we are getting a number of headlines, in fact, around chip sales to China. CEO Jensen Huang telling reporters Nvidia is working with the U.S. government to bring a follow-up to its H20 chip to China. The move would, of course, need to be approved by the U.S. government. Meanwhile, the information is reporting that Nvidia is halting some of its H20 production for China. That directive coming after the Chinese government told local companies not to buy the chips due to security concerns, they said. So what will Nvidia's new China playbook look like, Dan? What do you think?
Yeah, I mean, obviously they want to be a part of this space. Jensen Huang has gone to great lengths to explain why Nvidia should be there and why U.S. tech companies should be there. More specifically, talking about how it would create a bifurcated system where, you know, it's U.S. AI versus China AI around the world. His view is, let's just make it all U.S. Let's put U.S. chips wherever we can, and then other countries would have to then rely on them. And so that's kind of been where I think the administration is focused right now. There's obviously detractors from that idea as well. But, you know, the plan going forward now appears to be a Blackwell-based chip for China. We haven't had any real details on that coming from Nvidia quite yet, but it would obviously offer some of the capabilities of Blackwell, but, you know, as in terms of video game parlance, nerfed, less powerful than you would have from the standard Blackwell that's available, and, you know, kind of in line with what you saw from the Hopper to the H20 as far as performance goes. But, you know, China, an important part of Nvidia sales. I think it was $17 billion in sales in the last fiscal year, but they did $130 billion in overall revenue. The bulk of that still comes from U.S. sales. So, you know, an important part, but not necessarily the most important part. And, you know, speaking to our colleague Julie Hyman before about how, you know, analysts had taken the China equation part out of the equation when the ban had gone into place, and, you know, things were rocky at first, but then they were like, okay, well, now we don't have to think about this, so everything's hunky dory, and you saw share prices continue to rise. Then China came back into the equation, and you saw shares rise again. So it's just, you know, I think it's the unknown that is kind of rankling people to a degree. They want to know, look, is the company going to be seeing revenue from China or not? And then once that's figured out, then they can say, okay, here's how we're going to be projecting going forward. But at this point, it looks as though they're going to be using or trying to get Blackwell chips into the country. We'll just see how China responds to that, because, as you said, the government seems to be pushing back on the use of some Nvidia chips.
Lou, listen, I'm an Nvidia investor. I'm listening to this right now. Bottom line, as Dan's saying there, I just want to know long term, what does Nvidia's business look like in China? How much money can Jensen Huang actually make over there? How does this shake out? Or maybe there's too many balls in the air and I just can't know that yet.
No, I'm a long-term Nvidia shareholder as well, and I think there's a lot of noise in the headlines, but a lot of action being taken at headquarters. This has happened before. If you look back to when Apple phones were, rumored to be banned in China, and then that turned out not to be the case. I think here, that Nvidia chips are needed by China. You're seeing in the headlines a policy stance that says we don't want them here. I don't think that's actually true. We saw this in the smartphone boom going back for RF chips. China's an important market for Apple, for Nvidia. And we're talking about this here. There was a $5 billion plug that got put back in, right? There's an estimated $5 billion in revenue that Nvidia was going to make, not going to make. I think long term, there's going to be a big market here. It's just figuring out what tech is permitted and how Nvidia negotiates and navigates having a potential 15% tax on sales there. But the demand is there. The chips will be there. I think this headline passes pretty quickly.
All right. Dan, Hallie, thank you, sir. Appreciate it. And we are just getting started here on Market Domination. Coming up, crypto stocks soaring after a tough week. We've got a look at the rally straight ahead. And some of the most influential voices in markets economics huddled in beautiful Jackson Hole, Wyoming. When we return, an interview with Nobel Prize-winning economist Claudia Golden and American clothing brand Gap set to report earnings next week. But analysts aren't so bullish. Those stories and more when we return. Now time for some of today's trending tickers. Lou Bassanese from Prairie Operating Company is here with me. We're going to take a look at crypto, at Gap, at Apple, but we're going to start here with crypto. Ethereum leading crypto gains following Fed Chair Powell's speech at Jackson Hole. Risk appetite rising as Powell does open the door to a September rate cut. So it's interesting, Lou, because crypto, we've been talking about digital assets on the show this week. Of course, we had the rally in Bitcoin. We hit the record on August 14th. And then heading into Powell's speech, though, Bloomberg pointed out, Lou, you actually saw spot Bitcoin ETFs in the U.S. They had logged 4 straight sessions of outflows. Yep. But I'm looking at Bitcoin, nice day in the green.
No, I think I look at these cryptocurrencies as not a crypto guy first. Now I'm coming around to the adoption as a risk-on barometer, right? You have the fear index and the VIX. Bitcoin's the greed index, but I think something more structural and foundational is happening. I sit on a couple boards, and the amount of institutional demand to turn into companies into crypto treasury companies is really remarkable. I'm seeing it firsthand, and I think it's because it makes it frictionless, right? Now, if you try and buy crypto on a traditional exchange, you can't trade the derivatives around it. But when you get it into the equity markets, it can be custodied by any type of investor now. And so I think this is really driving demand, taking supply off the market, and then you get just the increase in speculation as well, leading to this rally.
Are you in the camp that says, hey, I know we dipped, I think it was like a 112, and I heard folks saying, hey, maybe we're just kind of consolidating here, and they were saying, listen, we're going to move higher into year end, and don't complicate it. They were saying it's just a friendlier regulatory backdrop, and to your point, they'll say, yes, strong institutional demand.
Yeah, seasonality comes into play here. The other thing that I look at, the data point that's interesting, is what's the marginal cost to mine the next Bitcoin? It really closely tracks and highly correlates to the actual market price. So obviously electricity prices are going up, the cost to mine the next Bitcoin's going up, so we should expect the market price to go up, otherwise the miners are going to come out of the business.
All right, here's another one I want your take on Gap. As that one got hit with a downgrade at Barclays, the firm lowering its rating on that stock from overweight to equal weight. So they moved to the sidelines. They said the previous bullish scenario, Lou, for double-digit operating margins by 26 off the table. Previous blue sky scenario, they say, diminished by tariff margin pressure, macro uncertainty. Their target goes to 19.
I think they might have been a little too aggressive because I don't hear any other analyst comments in the retail and apparel sector talking about blue sky optionality. If you looked at Gap's last quarter, it wasn't terrible. They had about 3% comp, same-store sales comps. Old Navy showed some strength, which it hadn't, and the athletic division showed some weakness unexpectedly. So, and even earnings were up 24% quarter over quarter. So it looked like a solid enough report in a market and economy where the consumer has been a little stretched and everyone's worrying about this. So I think they were a little too aggressive. Makes sense to step to the sidelines ahead of the report and then maybe come back in.
Next earnings announcement, August 28th, Lou. We shall see. Apple, let's finish up there. In early discussions to use Google Gemini in a revamped version of Siri. Now, this is according to Bloomberg, Lou, and they're saying Apple's considering using Google Gemini AI to power a revamped version of Siri. The report saying Apple approached Alphabet's Google to explore building what they say is a custom AI model that would serve as the foundation of this kind of new Siri next year. What do you think?
I'm deeply conflicted because I own Apple and Alphabet, but I would say this, it makes strategic sense. Apple has been behind. They're used to being a late entry and then leading eventually. But here's the argument I'd make. Both Apple and Meta, what is the benefit of originating your own AI? You're not doing cutting edge compute for what your product lineup is. Meta is simply advertising, digital advertising. Apple is consumer products. So I think it makes strategic sense for them to outsource the brain behind their AI and then just leverage it in and incrementalize it into their business. So for me, it's a smart move.
Bloomberg saying here's Apple's still several weeks away from making a decision whether they continue using their internal models for Siri or move to a partner, and then they have to decide if they go that route, which partner it would be. We've heard a few different names, and of course, then we have to find out, Lou, what even the financials of such a deal would actually look like.
Yeah, and you saw, last week we heard the rumors that, or the clamoring for Apple to buy Perplexity, right, to just bring it in-house.
I had guys pounding the table on that, on this set.
But Apple's never made acquisitions that big. They've always been very
biggest was $3 billion ever for Beats.
Right. So they're not going north of $10 billion. I think that, again, it makes sense vertically integrate in what you can and then outsource what you need from AI.
When Tim Cook takes that stage, you expect in September those new iPhones. Exciting, you think, for consumers, for investors?
He doesn't have.
There's hot talk of a thinner iPhone.
Does that get you excited?
New form factors, they tend to excite people.
Tim Cook is an incrementalist.
Yeah.
Steve Jobs was an innovator. I think that Apple really just has to iterate to really stay relevant. Yeah. They don't have to innovate that much. I wouldn't expect fireworks from Tim Cook. That's not his MO. He doesn't have that same gravitas. I think they just have to show that they have a plan that is getting put in place for AI that's going to monetize it.
All right, we wait and see. Meanwhile, the labor market, front and center at the Jackson Hole Economic Policy Symposium, from Powell highlighting labor risk to its dual mandate to discussing surrounding labor transitions, particularly the role of women in the labor market. Jennifer Schonberger sat down with Harvard professor Claudia Golden at Jackson Hole. Take a listen.
Joining me now is Claudia Golden, professor of economics at Harvard University and 2023 winner of the Nobel Prize in Economics for her groundbreaking research in women's participation in the job market. Professor Golden, an honor to have you here on Yahoo Finance. Thanks so much for joining me.
Thank you.
The theme of this year's symposium is labor markets in transition, and this morning you presented a paper entitled The Downside of Fertility, in which you say even though the major factor in the decline of fertility is increased women's agency, the real downside or obstacle is the need for husbands and fathers to reliably demonstrate their commitment.
That's right. And not just commitment, I mean the actual time and the resources. And without that, women will not have as many children because they have more autonomy, they have more agency, they have more education. They should have equality.
So how do we create a shift? Because this seems like it is very culturally embedded here.
Well, the shift is pretty simple, I think. The shift is that men want children too. And men really should want equality too. And I think that we have to sort of get ourselves out of a bad equilibrium into a better equilibrium. And there are certain places, Sweden is one of them, where we see that this movement has occurred.
And so then what are the implications here as we look at the job market? As I mentioned at the top, you were the 2023 Nobel Prize winner in economics for your research in women's participation in the labor market. What are the implications for women's participation on the job market here?
Well, the implications are that women want to be employed. They want to have good careers, but they also want to have families and they want to have children. So I think that they will not give up on one or the other, but the problem is that why have children if they're going to be the only ones really taking care of them? Why have children if there are going to be risks, not just to themselves, but to their children? So I think that the labor market and demographics are one and the same.
And then if we look at the gender pay gap and the cost of childcare, because you're talking about women want to raise children or need to raise children, but they also want to work. How much does the cost of childcare factor into this? Because everywhere I go and all of the data that we look at shows it's so high and not coming down anytime soon.
The irony is that the reason that childcare costs are high is because it's labor costs that are high. And an individual who is highly educated and well-trained is the person you want to trust your child to. And that person is going to be expensive. And that's just the way it is.
So are there any solutions to try to lower the cost of childcare, do you think?
The solutions to lowering the cost of childcare is, in fact, ironically, to bring down the wages of women, and that's not something we want to do. So I think we just have to realize that children, wonderful as they are also going to be somewhat expensive. That's just the way it is. Think about the following. If a college-educated woman is taking care of the child herself, the cost of the child is 100% the value of the college-educated woman. If the child is taken care of in a facility that's very high grade, then maybe it's 3 children to every 1 college-educated woman. The cost comes down. But still, the rate of change in that cost is the rate of change of the value of a college-educated woman. It's going to be high, and it should be high.
What are the implications then for the U.S. economy? We know that the magical equation for growth is population growth plus productivity. And if fertility rates are on the decline, and it doesn't sound like that's going to change anytime soon, what does that mean?
We really care about the GDP per capita. We don't care entirely about the total change, GDP, period. We care about GDP per capita. So that's a slightly different equation.
As we look at the cultural side of this, not the economic implications, I'm curious, when you look at marriage and commitment, do you think that the onset of dating apps has factored into this, pushing out the age for marriage and pushing down the levels of fertility that we've seen?
The age of marriage started to increase around 1972 in the United States, and that was in response to the fact that women had more autonomy, because that's when the birth control pill was more available for single young women. So there were no dating apps, as I recall then. Dating app was just going to a party and meeting friends.
Right, so it sounds like it was the advent of the pill, and from there it sort of accelerated, is that right?
It's the advent of a host of different technologies and cultural aspects that led to greater female autonomy, and we should be very happy about that.
And Professor Golden, before I let you go, do you see this trend continuing? Do you see fertility getting worse and lower as we go through the next decade, or is there anything that could change things?
Okay, first of all, I wouldn't say it's worse. It's what it is. I think that the problem is a mismatch. Both women and many men would like to have more children, and they just have to get together and agree on sharing not just the burden, but the joys of having children.
Professor Golden, thank you so much for your insight. So appreciate it. Appreciate you joining me today.
Thank you.
Coming up, stablecoins poised to reshape the multi-trillion-dollar US Treasury market. We're going to explain why when we return. Stick with us. The Treasury market could get a boost from an unexpected place, stablecoin issuers. Yahoo Finance's Inez Ferre joins us now with more. Inez.
Yeah, Josh, with the U.S. debt at $37 trillion, that's 12 zeros after the 37. Well, the Treasury market is eyeing stablecoin issuers as top buyers of T-bills. And of course, this comes after the Genius Act was passed, this legislation which creates guardrails around the stablecoin industry. And what the law says is basically that tokens have to be backed by U.S. currency. So these stablecoin stablecoin issuers need to have reserves in the form of U.S. currencies or high-grade liquid assets. So this puts front and center T-bills. With respect to the Treasury Department and some comments that this week Treasury Secretary Bessent said, he said this before, that stablecoins are going to expand the dollar access for billions across the globe and also a surge in demand for U.S. Treasuries. The stablecoin market right now is $250 billion, and Wall Street is expecting it, depending on which forecast you look at, it could go to $2 trillion by 2028. You've got Bernstein that's saying $4 trillion by 2035, but nevertheless, it is going to explode according to Wall Street. Right now, stablecoin issuers hold about 2% of the T-bill market. So if you think about the exponential, the growth that you're going to see in this market, you've got ARK Invest that's saying that, look, Tether back in 2024 was the 7th largest buyer of treasuries, ahead of the UK and also Singapore. They're saying that you could see Tether and Circle, which dominate the stablecoin market right now, leapfrog other countries to become top buyers of treasury bills, of T-bills, as the stablecoin adoption continues.
Inez, thank you.
Thank you.
Industrials, the top performing sector in the S&P 500 so far this year, up more than 16% now year to date. And as markets rally around Fed Chair Jerome Powell's comments on the path forward for interest rates, there could be some interesting opportunities for investors within industrials. We're navigating how to play the space with the Yahoo Finance Playbook. Joining now is Kristen Owen, Senior Analyst and Managing Director at Oppenheimer. Kristen, it is good to see you. So let's start with the news today, Kristen. That would be Jay Powell, Jackson Hole seems to be suggesting there, Kristen, a policy pivot is on the way. Let's say that happens. What could that broadly mean for the industrials you cover, Kristen?
Yeah, thanks, Josh, for having me on. It is an interesting day and one where we're seeing a little bit of exuberance come back into the market. And I think the expectation here is, both a little bit of clarity, and this has been a market that has been missing clarity thus far this year. So a little bit better certainty with respect to those September rate cuts, but also a little bit better on the affordability front. When you think about industrials, I mean, we're talking about capital equipment, capital goods. These tend to be large, in some cases, multi-million-dollar investments that really make our economy run. And so if we are at a point where we're now starting to see rates come down, or the expectation that rates are going to come down, that affordability piece gets a little less challenged, and the decision to make some of those larger investments becomes a little bit easier here. So the way that I look at it, we've got some certain pockets of the market where there are some clear opportunities. When you look at who's responding well today, and you see a name like Caterpillar up 4%, certainly getting some benefit from the opportunity for resi improvement. And that's something where, we think that there is a real opportunity now in anticipation of rate cuts that could revive this resi sector that's been bumping along the bottom. A few other names in that space that we like. Trimble would be one that we'd put in that bucket. A little bit less capital intensive, but certainly tied to that affordability and improving resi and housing outlook. So I'd leave it there. I mean, we have a lot of opportunities here for the affordability to get a bit better.
And Kristen, for investors, the Fed, one critical theme. Trade is another, Kristen. Now, I think about trade tensions. I think about some of those industrials being front and center. And I'm just curious how the names you cover, Kristen, how have they been sort of just navigating that tariff dynamic, mitigation strategies, levers they've been pulling?
Yeah. Josh, I started with this idea of clarity or certainty, and that's something that has really been a challenge for a lot of the companies in this space. And that's primarily related to the tariff backdrop. How we've seen most of our companies respond thus far is take a slow and steady approach It is how can we control the controllables? Let's try to make any move that we take more palatable for our customers, meaning it's not necessarily a knee-jerk reaction to increase price. Let's see what we can do within our own supply chain, and let's not make any any regrettable decisions at this point, given that we haven't had a lot of clarity on what that tariff backdrop is going to look like. So some of the other developments this week, a little bit more codification on what EU tariffs are going to look like. That's going to create a little bit more certainty for how do I address my supply base that may be coming from Europe? How do I think about those Section 232 or the steel and aluminum tariffs when I'm starting to think about how I build this piece of equipment or this piece of machinery? And first and foremost, starting with the supply chain before thinking about, do I need to reshore? Do I need to bring more of that manufacturing back either to the United States or under USMCA compliance?
Kristen, I want to end here with some picks, some names. Caterpillar is one name I know you mentioned. I know you like that. You also like Deere. Why is that one a buy here, Kristen?
I mean, Deere is one that can also benefit from the construction side of the business. We don't often talk about Deere's construction business, certainly more well known for its ag business, but that's one that can benefit from this affordability backdrop. On the ag cycle, I mean, ag tends to move to the beat of its own drum. And from that respect, Deere is the best in class name that you can own in the ag machinery space. And what we would really benefit from, in addition to the rate cut, is really understanding what trade policy is going to look like from an agriculture market perspective. That's going to be more meaningful for the commodities backdrop. That's really going to be the kicker to Deere shares here. Right now, what we like about Deere is with a little bit of help from the macro, you can still get earnings growth next year, and that's what's currently being priced into the stock. On top of that, you get a nice dividend, you get high quality management team, strong free cash flow conversion. These are all things that for a multi-year investor really screen quite well here.
And how about CNH, Kristen?
CNH is much more of a self-help story here and hasn't had as much of a run as Deere has had. So you don't have that premium multiple applied for CNH. We think that actually creates a multiple opportunity for them. They've called out 350 to 450 basis points of operating margin opportunity just within their control, just by executing better quality equipment, integrating more of their own technology into their machines. So when I think about Deere versus CNH, Deere is probably already well priced for a lot of the premium execution that they get. CNH has a little bit more of a catch-up opportunity and is trading at a slightly lower multiple, so a little bit more attractive valuation relative to Deere.
Kristen, appreciate your time and those picks. Have a great weekend.
Thanks, Josh.
It's a record day on Wall Street for the Dow, thanks to Fed Chair Jerome Powell. Got a closer look at the rally straight ahead. Get a quick check on shares of Opendoor, spiking nearly 40% on the day. It's one of the top trending tickers. Lou, your take on the move in this name. You bought into this name, Lou. You are a believer.
I am a believer, but I think this is based on Powell and interest rates, right? I had Eric Jackson on my podcast. Before he even started getting out on Opendoor, we were talking about the names in the Bitcoin mining space that pivoted. He does his work. He is a very fundamental.
We had him on the show, and he does his work, and he makes a strong, compelling case.
Yeah, it's a real estate rebound play, and it makes sense to me, right? Interest rates come down. The real estate market is the one thing that's dragging back this economy and the market. There's a fear there that it's going to really pull things back. Now we get the hope of interest rate cuts. It makes sense that it's rallying this high today on the fundamentals alone.
Do you put Opendoor in the meme stock category? Because I think, correct me if I'm wrong, doesn't Eric Jackson say no, it's not a meme stock?
No. I'd say no, but it's meme-like because it's leveraging.
What do you mean by
meme-like to me? A meme stock has no fundamental basis for rallying, right? There's not a fundamental value to the business. It's just like when AMC was running and no one wants to go to movies anymore, or GameStop, no one's doing video games. But with Opendoor, there's a real estate business there, but it's attracted the retail audience, which is now a bigger contingent than ever, right? It's a force that has to be reckoned with. They actually got a CEO to resign.
Remarkable.
So, retail investors account for now upwards of 32% of daily trading volume. Long-term average is 12%. If you look at the options market, they're now 30%. So this is a change, a paradigm shift on Wall Street that the C-suite now has to pay attention to. So interesting times we live in.
Got to stop and listen. All right, markets on the rally here on the back of Fed Chair Jerome Powell's interest rate commentary in Jackson Hole. Senior reporter Alec Canal here with the Yahoo Finance Playbook.
Stocks ripping higher to close out the week after Fed Chair Jerome Powell opened the door to a September rate cut at Jackson Hole. Powell saying, quote, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. That fueled bets that the Fed could ease as soon as next month. Markets took that as a green light for risk. Meme darling, open door that jumped more than 30%. Ethereum spiked 13%, outpacing a 4% gain in Bitcoin. And the enthusiasm spilled into some of those crypto-linked names as well. Coinbase gained around 7%, Robinhood up 4%, Strategy up 6%. And this marks a sharp rebound after a pretty rough stretch for some of those high volatility plays. Citi strategist Scott Kroner called the market reaction, quote, very positive, highlighting that a striking surge in small caps, along with the equal weighted S&P 500, leading the headline index. It's really all in congregate a sign that the rally may be broadening beyond just big tech. Still, Kroner cautioned that there was some junkiness as unprofitable growth names also surged, but just really an overall risk-on rally here amid Powell's dovish tilt. The question, of course, now is whether this proves durable. Here's some of the reaction that we heard today following that speech.
I think he laid out the options in front of us. And not commit to anything. This is important. I know the markets think that he's committed, but I think at this point, there's a lot of uncertainty. I know that word's being used a lot, but the signals are mixed.
What Powell was trying to do today was to open the door to a rate cut in September. And what that does is that gives him a little bit of insulation, because if we get a really bad jobs report next month in early September, he can say, look, I opened the door to a move. Don't worry, we're on it. It's coming.
In a way, maybe he's auditioning for the role of Fed chair. If you look at the text of the speech, he actually completely removed the phrase that has characterized his entire term as Fed chair of data dependent. That wasn't in the speech. And he's talking more about the balance of risks, looking ahead. And it was actually kind of refreshing to hear that.
Now, there is going to be a fair amount of data that will be released prior to this September decision. And as you just heard, there's still some uncertainty related to the inflation side of the Fed's dual mandate. So we'll have to wait and see. But right now, markets clearly interpreting this as a rate cut in September, Josh.
All right, Alec, now, thank you. While wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell.